Hello, everyone. Dividend Enjoyer here. Hope you're having a great end of your week. Today, we're going to be doing a stock analysis video on MGM Resorts International, ticker symbol MGM. The stock currently trades for $32.89. The stock is down 23.26% over the past year. The market cap of MGM is $9.79 billion. The price to earnings ratio of MGM is 11.75. They do not currently pay a dividend, and the 52-week low is 31.61, and the 52-week high is 58.24. We're going to see if this is, oversold, overbought, what I think the fair value is. But before we get into that, let's see what the analysts have to say. Analysts are very bullish on the stock. With 23 analysts total, 5 rate MGM as a strong buy, 13 rate it a buy, 4 rated a hold, and it looks like 1 rates it underperform. MGM's price targets from 1 year out range from $37.50 all the way to $56, with an average analyst price target of $48.70 next year. And again, the stock currently trades for 32.96, so this represents a significant gain, and if this happened, would probably beat the S&P. Before we get into the DCF valuation, I just want to talk about kind of my concerns with the business and what I think of MGM, particularly just compared to something like DraftKings, because I've done a significant amount of research on DraftKings, which is why I'm kind of making this video. I also have done a significant amount of research on Vici, and I believe that Vici owns their physical casino rights. So with MGM, I think that you have the benefit of getting the physical locations along with an online sports betting app, but I don't think they're really the leader in the online sports betting, but I do think it's something that's going to continue to grow. One thing that I noticed when doing my weighted average cost of capital, along with just analyzing the company, is that there's significant debt. In fact, if I remember correctly, the amount of debt for this company actually exceeds the current market cap of the company. So if you're someone who doesn't want to invest in a company that has significant amounts of debt, then I would avoid MGM at all costs. You also have to know that they were extremely hurt by COVID. COVID crushed them. I think having the MGM Sports app is going to help them to have some kind of more resiliency, I would say, to another COVID-like event. But if another COVID happens, the stock is pretty much cooked for all intents and purposes. They've been able to grow the revenue 12.31% year over year, which is significantly better than the sector median of 2.34%. But the cash flows are really inconsistent, which I don't like. I think that this stock very well could be undervalued. And if that's all you're looking for, this might be a buy for you. But personally, for me, this doesn't have the types of things that I see in a stock and meet my basic criteria. So the DCF is kind of where I'm willing to buy, but I'm not even willing to buy a company like MGM just personally. And again, this is not financial advice. The stock could be a buy, okay, but it also could be a sell. What I'm trying to say is fundamentally, the way that they operate as a company, I don't think I would want to own them just because I don't reliably know that they're going to be able to grow pretty consistently and that there's a lot of pathways for them to growth. I also don't like I just personally, as an investor, do not like to see a lot of debt on a balance sheet. That really scares me a lot, and that sort of thing really worries me. When there's a lot of debt on a balance sheet and there's not a reliable way to make that money, I just don't like that. Now, do I think MGM has the ability to perform? Yeah, I think that the house always ends up winning eventually, right? But is MGM a better investment than an Amazon or a Vici or, a multitude of other companies that are very high quality? I don't think so. I would put this in its business model as I would even put it below a lot of very stable companies like a Coca-Cola that doesn't have a lot of growth, just because I value the essentially safety and constant returns and just the idea that the company is very strong and doesn't have a ridiculous amount of debt that's crippling it, to a company that is in a very competitive situation. Like, they can't offer certain sports betting odds that are more favorable to the consumer because they'll lose money. I mean, sports betting is pretty much as monopolistic as it gets because everyone's competing, and you're competing with DraftKings, you're competing with FanDuel on the digital side, and I think the app is just terrible at this point. I just don't see management doing anything that makes me say, wow, this company is amazing. The cash flows are, seriously just sporadic. They're not consistent. They're not consistently growing. I just don't like this stock personally. I don't want to buy it. I don't care what the valuation says unless it's extremely cheap. But even then, I don't like this stock personally. I'm not going to be adding it to my portfolio. And those are just my kind of thoughts. I don't like the underlying business. I think it's too competitive. I think they have too much debt. I think there are too many things here that make it feel kind of like a value trap to me. That's kind of how I'm feeling about MGM. I think it might be a value trap, or, it's one of those things where I can't really call it. I'll be completely honest. It could go either way, and I don't like that. I like owning companies that I know are consistently going to go up and produce just crazy cash flow in the future, and that I can hold for 5 years and know that the value is going to go up. This does not seem like that kind of play. This seems like the kind of play that, yes, it's a stinker. There's a lot of bad things going on for this company, but if you can get in at the right time for the right price and just hold it forever, you're going to probably make a lot of money. That's kind of the feeling I get. I don't feel necessarily this is a value trap that's going to increase forever. I think that, there'll be good and bad times of this stock, and right now it's a bad time, so it might be time to buy, but I don't want to play that whole game. I actually want to know that what I'm owning is very high quality. Even if I have to pay a little bit of a premium for it, I'm willing to do that. And this company, I'd rather own DraftKings just personally as well. I think that there's going to be more money in that. I think that, maintaining all of these physical properties is going to be, a major headache in the future for MGM. I do think it makes them a lot of money, but I just think DraftKings is more compelling because I think that it's a lot better when you're just buying one thing. I think MGM is involved in too many things for my liking as an investor. I like the idea of a DraftKings that, yes, isn't profitable yet, but they're doing the right things and they have a lot of the market share in an industry that's growing. I don't think MGM is really going to be able to consistently grow their cash flows. And just as a business, I don't like it. But now that long rant is over, let's get into the discounted cash flow model valuation for the company. First off, I don't think that this is actually their cost of debt. I think that this interest expense, there's probably long-term debt where they haven't paid it yet because I use the trailing 12-month number of the free cash flow. So I think a weighted average cost of capital of about 4.35 or 5.35 is more appropriate. I used 5.35 here, and even with a 1% growth rate, you're getting upside of 13.94%. So essentially, if you think MGM can consistently grow its cash flow, I think that you probably should be an investor in this company. But I think that, it's not reasonable to expect that because the average has been negative 21.15% free cash flow growth. And this was obviously a huge negative free cash flow amount in the COVID years, which crushed this company. And I'm just not a buyer in this company. I just don't think that they can significantly make money. I don't like the idea of literally putting your money into a casino and gambling it. I also don't like hotel companies just because the margins are so low. It's so difficult to run something like that efficiently and to make the money back on it after you've paid all your employees. And you have to make sure your occupancy is good, reviews are good. Everything has to go your way to make money. I don't like hotels and hospitality. If they just had the MGM app and it was for the right price, I think I would buy into that. But again, I might be MGM's biggest hater in this video. So, take what I say with a grain of salt, I guess. But if you believe that the company can grow free cash flow at least, excuse me, 50% growth rate, I mean, that's like the break even for this discount rate. If we decrease the discount rate 4.35, which I don't think is realistic, then obviously you get way more upside. I think it's more likely 5.35. Just personally, that's what seems correct to me. That seems more in line with the price as well. But I think that this really, if you guys are looking at this objectively, I think that this is a trap. I think this is a situation where this stock is too good to be true. And I think that it's going to continue to fall personally. I think that they have a lot of debt. I don't think they're ever going to really go out of business. I think they're always going to make enough profits to continue operating. I just think that there's so much uncertainty. This stock could either 4x or go down to $15. I think those are the two scenarios that could happen with this stock. Or it's just going to stay exactly where it's at, but it's going to be a wild ride. I think it's too much of like gamification if you buy into the stock, but you can do whatever you want to do. I do not like this stock. I think I've made that very clear. I don't like the fundamentals of it, and that's the most important thing in my opinion. And for my investment philosophy, I think you have to invest like you're playing tennis or you're playing golf. You have to make as few mistakes as possible, play conservatively as possible, and play to your strengths. And I don't think that this stock plays to my strengths. I think it's too unpredictable. I think that there's a lot of uncertainty. I think that, it's literally gambling, and that's not the way I want to invest. I think that the valuation, they're probably undervalued. It's probably worth more than the value there, but it's also very difficult to value because of the inconsistency. Inconsistency makes things very difficult to actually evaluate and be able to make a decision on. And for that reason, I don't think I would want to buy this stock.